On the surface, this looks like silver is failing. But when you examine what central banks are actually doing with their reserves right now, when you track the industrial data, nobody's connecting to the monetary shift. When you track the industrial data, nobody's connecting to the monetary shift. When you map the exact sequence that played out in '79, in 2011, in 2020, you realize something far more calculated is happening. This isn't silver lagging behind. This is silver loading. And what comes next depends entirely on whether you understand the difference between those two things. Welcome to Black Silver, where we don't insult your intelligence with hype cycles or lottery ticket promises. If you've been managing capital long enough to know that timing matters more than hoping, then you're in the right place. Do me a favor, hit that subscribe button the same way you'd bookmark a research report you know you'll need to reference later. Because what we're about to walk through isn't entertainment. It's strategic positioning. And drop a comment letting me know, what city or country are you watching from? I want to know where the serious money is paying attention right now. Let's get into it. When gold crossed $2,100 in late 2024 and held that level into 2025, something shifted in the institutional world that most retail investors completely missed. It wasn't just another price milestone, it was a signal. Because gold doesn't break multi-year resistance patterns without serious capital behind it. And serious capital doesn't move without serious reasons. While financial media celebrated the breakout with surface-level explanations about inflation fears and geopolitical tension, the professionals who actually manage billions were watching something else entirely. They were watching who was buying and why those buyers don't care about short-term price swings. Central banks added over 1,000 metric tons of gold to their reserves in 2023 alone. That's the second highest annual total ever recorded. And in 2024, they didn't slow down. China's official reserves grew month after month. Poland doubled its holdings. Singapore quietly accumulated. Turkey continued stacking despite currency crises at home. This isn't speculation. This is institutional behavior that telegraphs a very specific concern. The kind of concern that doesn't get announced in press conferences, but shows up clearly in vault inventories. When a central bank buys gold, they're not trying to make a profit. They're not betting on a trade. They're answering one single question. What holds value when the currency system we've built over the last 50 years starts showing cracks we can't patch with policy anymore? And the answer, apparently, is the same answer it's been for 3,000 years, gold. But here's where it gets interesting for anyone paying attention to silver. Silver didn't follow, not yet. While gold broke out and held new highs, silver stayed locked in a frustrating range between $22 and $28 per ounce, the same zone it's been grinding through since 2021. On the surface, that looks like weakness. It looks like silver is being left behind. Like the story isn't working. Like maybe all those people talking about industrial demand and supply deficits were just wrong. But that's not what's actually happening. What's happening is something far more mechanical and far more predictable if someone understands how these two metals actually function in a crisis cycle. Gold leads because it answers a monetary question. Silver waits because it answers both a monetary and an industrial question. And right now, only one of those questions is being asked with urgency. Think back to 1979. Gold began its explosive move in late 1978, driven by collapsing confidence in the US dollar and rising geopolitical instability. It climbed from $200 to over $500 before silver even woke up. Then, in late 1979, silver suddenly went parabolic, rocketing from $6 to $50 in a matter of months. The delay wasn't weakness. It was the market waiting for industrial and investment demand to catch up to what gold had already been signaling. The same pattern played out in 2010 and 2011. Gold broke $1,400 in late 2010, while silver still traded under $20. Investors panicked, thinking they'd missed the move. Then silver ran from $18 to $49 in 6 months. Again, delay, then explosion. In 2020, the story repeated. Gold hit new all-time highs above $2,000 in August 2020. Silver was still under $20 in March of that same year. Then it doubled to $30 in a matter of weeks. Every single time, the pattern is identical. Gold moves first because it's the pure monetary metal. It's what central banks buy. It's what sovereign wealth funds hold. It's what moves when people with serious money start questioning whether the financial system is as stable as everyone keeps saying it is. Silver waits because it's a hybrid. Yes, it's a monetary metal with a 5,000-year history as money. But it's also an industrial metal that powers solar panels, electronics, EVs, medical equipment, and grid infrastructure. That dual nature creates a lag. Because while central banks can decide to buy gold overnight, industrial demand takes time to accelerate. Manufacturing cycles don't turn on a headline. They turn on order books, capacity expansion, and capital deployment, all of which move slower than monetary panic. So when someone looks at gold leading and silver lagging and concludes that silver is weak, they're misreading the signal. Gold's breakout isn't a warning that silver failed. It's a warning that the first question, what preserves wealth in monetary instability, is already being answered by the largest pools of capital on Earth. Silver's time comes when the second question gets asked, and that question is coming. There's a structure underneath silver's price that most people never see. It's not visible on a basic price chart. It doesn't show up in headlines. And it's exactly why silver can sit motionless for months while gold climbs, and then suddenly move 40% in a matter of weeks. This structure isn't a secret. It's just ignored by people who treat silver like it's supposed to behave the same way as gold. But it doesn't. And understanding why it doesn't is the difference between positioning intelligently and getting shaken out right before the move actually happens. Let's start with the paper market. The COMEX, the exchange where silver futures are traded, handles a staggering amount of theoretical silver that doesn't physically exist in deliverable form. On any given day, the open interest in silver futures can represent over 1 billion ounces. Total registered silver available for delivery in COMEX vaults? Around 50 million ounces on a good month. That's a 20-to-1 ratio of paper claims to actual metal. Now, in stable conditions, this system works fine. Most contracts get rolled or settled in cash. Nobody demands delivery. The paper price and physical price stay relatively connected because there's no stress on the system. But the moment physical demand spikes, or vault inventories drop unexpectedly, or a large player decides they actually want metal instead of a cash settlement, the whole structure gets fragile fast. And here's the critical part most people miss. Gold has the same paper-to-physical dynamic, but it behaves differently under pressure because of who holds the physical and why they hold it. Central banks hold 36,000 metric tons of gold. That's roughly 18% of all the gold ever mined in human history, sitting in sovereign vaults with zero intention of being sold during a crisis. In fact, they buy more during crises. Silver? There's no equivalent strategic stockpile. Governments sold off their silver reserves decades ago. The US strategic stockpile is gone. China holds some, but it's a fraction compared to their gold. What physical silver exists is either in private hands, industrial inventories, or ETFs, all of which can be mobilized and sold when price spikes. That difference creates a liquidity problem. When gold moves, it's moving against a backdrop of deep, sovereign-backed physical supply that stabilizes violent swings. When silver moves, it's moving in a market where physical supply is fragmented, reactive, and thin, which means silver needs more capital flow to sustain a rally than gold does, and that capital flow hasn't arrived yet. Here's why. Investment demand for silver collapsed after the 2020-2021 rally faded. ETF holdings peaked around 1.1 billion ounces in early 2021, then bled out slowly as investors rotated into other assets. By late 2024, total ETF silver holdings sat closer to 850 million ounces. That's 250 million ounces of selling pressure absorbed by the market over 3 years. At the same time, industrial demand kept growing. Solar panel production alone consumed over 200 million ounces of silver in 2023. EV manufacturing added another 90 million. Electronics, medical applications, and grid infrastructure projects pulled more. So the market had rising industrial offtake and falling investment demand happening simultaneously. The result? Price consolidation, not collapse, not breakout, just grinding range-bound behavior while the underlying structure quietly tightened. But there's another layer beneath this that almost nobody talks about. Mining supply isn't responding. Normally, when a commodity sits above its all-in sustaining cost for years, new supply comes online. Miners expand, new projects get funded, production increases. That's not happening with silver. Primary silver mines that extract silver as their main product, represent less than 30% of total supply. The rest comes as a byproduct of copper, lead, and zinc mining, which means silver production is tied to the economics of other metals. Even if silver hits $50, a zinc miner isn't going to increase production just for the byproduct silver. They respond to zinc prices, not silver prices. And primary silver projects? They take 7 to 10 years from discovery to production. Permitting is brutal. CapEx requirements are massive. Ore grades have been declining for decades. Translation: there's no cavalry coming on the supply side. Meanwhile, registered COMEX inventories have been trending downward since mid-2024. Eligible stocks, silver that's in the vault but not available for delivery, remain high, but eligible can be withdrawn at any time. It's happened before. In March 2021, registered silver dropped below 30 million ounces, while open interest stayed above 800 million. The paper market didn't break, but premiums on physical silver spiked to $6, $7 over spot in some markets. That's the fragility. Silver hasn't followed gold yet because the mechanism that moves silver, sustained physical demand combined with capital inflows that overwhelm the paper structure, hasn't fully activated. But every month that goes by with flat supply, rising industrial consumption, and central banks confirming gold's monetary role, the trigger gets closer. There's a difference between a market that's ready to move and a market that's actually moving. Silver right now sits in the first category, but the distance between those two states isn't as wide as most people think. And the conditions required to cross that gap aren't mysterious. They're measurable. They're already forming, and they don't require guesswork if someone knows what to watch. Let's start with the one thing that matters more than any other single factor: Federal Reserve policy trajectory. Gold responded to rate cuts that started in late 2024. Those cuts weren't aggressive. They were cautious, methodical, telegraphed well in advance. The kind of cuts that signal a normalization cycle, not a panic. And gold moved anyway, because central banks don't care whether cuts are 25 basis points or 50. They care about the direction. But silver needs something different. Silver needs the Fed to either commit to sustained easing that floods liquidity back into risk assets, or it needs the Fed to pause long enough that inflation expectations start climbing again despite their efforts. Either scenario works for silver, but the middle ground, where policy stays cautiously restrictive while growth slows, doesn't. That's the environment we've been in since early 2024. But here's what's shifting in 2026. The lag between rate cuts and their impact on manufacturing activity is roughly 6 to 9 months, which means the cuts that began in late 2024 won't fully show up in industrial data until mid-2025, and their second-order effects won't hit until early 2026. If those cuts successfully stabilize growth without reigniting inflation, industrial metals rally. Copper moves, zinc moves, silver moves with them because of its industrial demand exposure. If those cuts fail to stabilize growth and deflationary fears creep back in, then policy has to ease even harder. That floods liquidity, and liquidity flows into hard assets when confidence in policy effectiveness drops. Either path leads to the same place for silver: The question isn't if, it's when. Now layer in the second condition, manufacturing cycle acceleration. Silver's industrial demand doesn't move on sentiment. It moves on actual orders, actual production scaling, actual deployment of technologies that consume silver at rates traditional manufacturing never did. Solar panel production is projected to grow another 18 to 20% in 2026. Every gigawatt of solar capacity installed requires approximately 9 to 10 metric tons of silver. China alone is targeting 400 gigawatts of new solar by 2027. That's not a forecast someone can dismiss. Those are state-backed infrastructure mandates with capital already allocated. EV production is expected to cross 18 million units globally in 2026. Each EV uses roughly 25-50 grams of silver, depending on the model. That's another 450-900 metric tons annually just from vehicles. Grid modernization projects across North America, Europe, and Asia are pulling silver into applications that didn't exist a decade ago. Smart meters, energy storage systems, high-efficiency transformers. This isn't speculative demand. This is contracted, budgeted, deployed demand that shows up in refinery order books and manufacturing inputs, regardless of what silver's price does in any given week. And here's the part that makes this different from previous cycles. In 2011, silver's rally was driven almost entirely by investment demand. Industrial offtake was stable, but it wasn't the story. The story was fear, momentum, and speculation. In 2026, industrial demand is the foundation, which means even if investment flows stay muted, the physical market tightens structurally. And when investment demand does return, and it will, it's hitting a market that's already under supply stress. Now add the third variable, China's export restrictions. In late 2023, China announced controls on gallium and germanium exports. In 2024, they added restrictions on antimony and rare earth processing technology transfers. Silver hasn't been explicitly restricted yet, but the precedent is set, and China controls a significant portion of global silver refining capacity. If Beijing decides that silver, like antimony, is a strategic resource they'd rather keep domestically or allocate selectively, the global supply chain doesn't have easy alternatives. There's no spare refining capacity sitting idle in Nevada or Switzerland waiting to pick up the slack. The infrastructure doesn't exist, which means any policy shift from China regarding silver exports doesn't just raise prices. It fractures the entire delivery mechanism that Western markets rely on. That's not priced in. Finally, there's the ratio. The gold to silver ratio, currently hovering near 88.1, is historically stretched. Over the past century, the average ratio sits closer to 60.1. During precious metal rallies, it compresses toward 50.1 or lower. In 1980, it hit 17.1. In 2011, it touched 32.1. The ratio doesn't predict timing, but it does reveal valuation dislocation. At 88 ounces of silver to buy 1 ounce of gold, silver is historically undervalued relative to its monetary cousin, even if industrial dynamics weren't tightening. When monetary fear confirmed by gold's strength combines with industrial demand acceleration and supply stress, the ratio doesn't compress gradually, it snaps. And 2026 is when all three of those conditions stop being theoretical and start showing up in data that can't be ignored. Markets don't speak in press releases. They speak in price action, order flow, and the quiet decisions made by people who move capital in sizes most individuals never see. And right now, what the gold-silver relationship is saying isn't subtle. It's a warning wrapped in opportunity, but only for those who understand what the sequencing actually means. Gold's breakout above $2,100 and its ability to hold that level isn't just a bullish technical signal. It's institutional confirmation that the largest pools of capital on Earth, central banks, sovereign wealth funds, family offices managing generational wealth, have answered a question that most people haven't even asked yet. That question is simple. What preserves purchasing power when monetary policy has exhausted its toolkit and currency confidence starts eroding in ways that can't be fixed with another round of interventions? The answer, clearly, is gold. But here's what separates strategic positioning from reactive speculation. Gold's strength tells investors where the risk is. Silver's lag tells investors where the opportunity is. Because if gold is already pricing in monetary instability, and silver hasn't moved yet, then one of two things is true. Either silver is broken and the entire thesis around precious metals is wrong, or silver is waiting for a second confirmation that hasn't arrived yet. The evidence overwhelmingly supports the latter. Silver isn't lagging because demand is weak. Industrial consumption is at record levels. It's not lagging because supply is abundant. Registered inventories are trending lower and mining output isn't responding. It's not lagging because investors have lost interest. ETF outflows have slowed and physical premiums are starting to creep higher in spot markets. Silver is lagging because it requires both monetary uncertainty and industrial acceleration to move decisively. Gold only needed the first condition. Silver needs both. And in 2026, the industrial piece is moving into place. So what does that mean for someone actually allocating capital? First, understand that positioning in silver before the confirmation signals arrive is inherently more volatile than holding gold. Gold's breakout is confirmed. Central banks are buying. Sovereign demand is structural, not speculative. The downside risk in gold, barring a complete reversal in monetary policy and a return to aggressive tightening, is limited relative to its upside. Silver, on the other hand, is still in the loading phase. If industrial demand falters, if China floods the market with supply, if investment flows don't return, silver can chop sideways for another year while gold continues grinding higher. That's the risk. But here's the other side. If the conditions outlined in Part 3 materialize, if Fed policy continues easing, if manufacturing data accelerates, if Chinese export restrictions tighten, if the gold-silver ratio begins compressing, silver doesn't move incrementally. It moves explosively. Because that's what happens when a thinly traded, supply-constrained market with massive paper leverage suddenly gets hit with physical demand that the structure can't absorb. Every single time, the setup looked the same. Gold confirmed the monetary shift first. Silver sat frustratingly range-bound. Then industrial and investment demand converged. The paper market couldn't suppress physical reality anymore, and silver compressed months of potential movement into weeks. So the strategic question isn't whether to hold silver, it's when to weight it heavily, and what metrics confirm that the timing is right. Here's what to watch. First, COMEX registered inventories. If they drop below 40 million ounces while open interest stays elevated, that's structural stress becoming visible. Second, physical premiums. If the spread between paper spot price and actual retail delivery pricing widens beyond $3-4 per ounce sustainably, that's a signal the paper market is losing its grip on price discovery. Third, ETF inflows. When silver ETFs start adding 20-30 million ounces per month consistently, that's investment demand returning in size. Fourth, the gold-silver ratio. If it breaks below 80.1 and holds, that's confirmation that capital is rotating from gold into silver on the belief that the catch-up trade is live. And fifth, manufacturing data. If industrial production indices in the US, Europe, and China all start ticking higher simultaneously, that's demand acceleration becoming undeniable. None of these signals require guesswork. They're all publicly available, updated regularly, and measurable. The mistake most investors make is treating silver like a lottery ticket. They buy it, hope it goes up, get frustrated when it doesn't, and sell right before the actual move starts. The smarter approach is treating silver like a position that's being built while the setup matures. Gold's leadership isn't a sign that silver failed. It's a sign that the first question, what holds value in monetary instability, is already being answered by the institutions that matter. Silver's response comes when the second question, what powers the infrastructure required to navigate this transition, becomes equally urgent. That question isn't rhetorical anymore, and when it gets asked with the same intensity that's already driving gold, silver won't ask for permission to move.